Every year, millions of Americans pay more tax than they legally have to. And the worst part, most people don't even realize they're making these mistakes. Some are missing deductions worth thousands of dollars. Others are accidentally triggering unnecessary taxes. And many are making retirement and investment decisions that quietly cost them a fortune over time. In this video, we're covering the biggest tax mistakes costing Americans thousands of dollars and exactly how to avoid them. Let's get started. Welcome back to Finance Plus. Today we're going to look at America's 7 biggest tax mistakes and how you can avoid them and save more money. If you're interested in building wealth, improving your finances, and making smarter money decisions, make sure you're subscribed. Now, let's look at mistake number 1. Waiting until tax season to think about taxes. One of the biggest tax mistakes Americans make is only thinking about taxes when it's time to file. By then, most opportunities to reduce your tax bill have already passed. The people who legally pass less tax typically plan throughout the year. For example, increasing retirement contributions, that's one. Harvesting investment losses. Tracking deductible expenses. Making charitable donations. These decisions often need to happen well before December 31st. Waiting until March or April means many of these opportunities are gone. Think of tax planning like investing. The earlier you plan, the more options you have. It's really about time. Now, mistake number 2, not maxing out tax-advantaged accounts. Another costly mistake is ignoring tax-advantaged retirement accounts. Many Americans are leaving thousands and thousands of dollars on the table every year. Now, traditional 401k contributions can lower your taxable income today. That means less money paid to the IRS. Meanwhile, Roth accounts can provide tax-free withdrawals in retirement. For example, someone in a 24% federal tax bracket who contributes an extra $10,000 to a traditional 401k can potentially reduce their current federal tax bill by around $2,400. That's real money staying in your pocket. That's not nothing. And over decades, the tax savings are going to compound and they can become enormous. Now, mistake number 3 is missing common deductions. Many taxpayers miss deductions simply because they don't know they exist. And by doing this, they are needlessly paying thousands more dollars in tax every year. These deductibles can come from many places, and people often don't realize many of these even exist. Some commonly overlooked deductions include student loan interest. That's a big one. HSA contributions, and we'll cover more on that later. Certain self-employed expenses. Home office expenses for certain qualified businesses. And charitable donations. Now, the key here is documentation. Without records, deductions become difficult to claim. If you're self-employed or run a side business, keeping organized records throughout the year can save countless hours and potentially thousands of dollars. It is a must. The IRS does not reward poor record keeping, believe me. But it also doesn't stop you from claiming deductions you're entitled to. It's all on you. Now, mistake number 4, selling investments without considering taxes. Many investors focus on profits. Very few focus on taxes. And that can be a very expensive mistake. When you sell investments, capital gains taxes may apply. The amount you owe often depends on how long you've held the investment. Assets held for more than 1 year generally qualify for long-term capital gains treatment, which can often result in lower taxes, as opposed to shorter-term gains, which may result in higher tax rates. A common mistake is selling investments without considering the tax consequences first. Some investors also miss opportunities to offset these gains with losses through a strategy known as tax loss harvesting, which we will go into in another video. A few minutes of planning before selling can save hundreds or even thousands of dollars in tax. Now, mistake number 5, ignoring health savings accounts. I told you I was going to get back to this one. Now, the health savings account, or HSA, is one of the most powerful tax tools available to you. Yet, many Americans don't even use it or don't fully understand it. And this is a big problem. HSA offers a rare triple tax advantage. And believe me, this is very rare and you should take advantage of it. Your contributions may be tax deductible, firstly. Your investments can go tax-free, another big one. And qualifying medical withdrawals can also be tax-free. You very rarely get these sort of benefits in an account, let alone all together. So this is huge. And very few accounts receive all 3 benefits. For eligible individuals, failing to use an HSA can be missing out on one of the most efficient wealth building tools available today. Now, mistake number 6, taking Social Security too early without a plan. This is something I don't think is talked about very much. For retirees, claiming Social Security without a strategy can be surprisingly costly. Many people take benefits as soon as they become eligible. However, claiming early can permanently reduce these monthly payments. Depending on your specific circumstances, delaying benefits may significantly increase lifetime income. So it may be better to hold off for a year or 2 or 3 and be better off in the long run. But it's important to remember there's no universal answer. The important thing is having a plan rather than making an emotional decision. A few years of patience can potentially translate into tens of thousands of dollars over retirement. And that's not something you want to miss out on. Mistake number 7, believing a big refund is always good. Now, many people celebrate getting a large tax refund and, all the benefits that come with that. And that's always a celebrated thing. And I understand, and that can be a benefit. However, in many cases, a large refund simply means you're giving the government an interest-free loan. You're losing out, essentially. Instead of receiving that money throughout the year, you've waited until tax season to get it. You've just left the rewards on the table. They may feel like there are benefits getting these refunds, but it's not free money. It's your money. And you've just given it to the government interest-free for a certain period of time, up to a year. Ideally, your withholding should be close to what you actually own. This allows you to keep more of your money working for you throughout the year. You don't want to just give away money for a year with no benefit coming from it. Now, the truth is that building wealth isn't only about earning more money. It's also about keeping more money you already earn. Small tax deductions and decisions today can have huge impacts on your financial future. A lot of these may seem like small decisions today that only save you maybe a few $100s here and there, but over time, over years, consistently doing this, making a routine of this, making a plan of this, tracking this, you will save thousands, if not 10,000s, I promise you. Which of these tax mistakes surprised you the most? Let us know in the comments below. And if you found this video helpful, please consider subscribing for more videos on wealth building, investing, real estate, and personal finance. Thanks for watching. We'll see you in the next one.